students, welcome to the lecture series on international business. Today we will discuss international finance and this is part 4. I am Professor Soma Sen Gupta, Kamla Nehru College, University of Delhi. Now we will discuss in this lecture a topic mergers and acquisition, and this we will discuss from the point of view of foreign direct investment. So, it is again a kind of foreign direct investment, mergers and acquisitions. They are popularly known as M&A. So, for foreign investors, M&A, that is mergers and acquisition, is often seen as the fastest way to achieve growth and expand their reach in a new market, because it involves already established companies and operations. So, here already the facilities of company is developed because you are acquiring a existing company. So, it means that it is already established. So, you do not have to invest much time and effort in creating a new entity, entirely new entity. So, this is a very common way of in foreign investment in different countries by either merging with an existing organization or acquiring an existing organization. It allows the acquirer to gain immediate access to the local firm's existing management, distribution networks and country specific knowledge, which are often difficult to build from scratch. Mergers and acquisitions activity has historically accounted for a large share of total FDI flows, global FDI flows, particularly in developed economies. And it is an age-old phenomena of foreign investment or foreign direct investment that they are using mergers and acquisition as a way of investing in foreign land. Now, first we will discuss mergers. As the name suggests, a merger refers to the combining of two or more companies into one to take advantage of combined resources and skills. So, if two or more companies combine together, we call it merger. Most of the time the companies are of similar size or similar business. So, the combined companies can be of equal size or different sizes in terms of assets and market power, but still we will find that in most of the cases the size of the company may be similar. Mergers are known as amalgamation in India. So, what we have understood is that when two or more companies combine together and they lose their individual identities to form a separate new entity by transferring all the assets and liabilities to the new entity, and it is known as merger. For example, Glaxo Wellcome and SmithKline Beecham companies ceased to exist after merging in 1999 to form a new entity named GlaxoSmithKline. Characteristics of mergers. So, first we will discuss the key or core characteristics of merger. Now, it is a voluntary agreement. Mergers are cooperative and mutually agreed upon by both companies, management and shareholders. So, it is more or less voluntary and it is not a hostile kind of acquisition. It is like negotiations takes place between the companies for a long period of time, and after several rounds of negotiation they decide to merge together. Creation of a new entity. The two companies dissolve their individual identities to form a completely new legal entity. Similar size and scope. Mergers often occur between companies of approximately equal size, leading to the term merger of equals. So, merger of equals is quite common, though there is no restriction. One big firm may get merged with a small firm, or a small firm can get merged with a big firm, but most of the time they are of equal size. Stock exchange. Shareholders of the original companies, they receive shares in the new company in exchange of their original shares. So, in such a way shares are exchanged in some ratio. Then synergy, there are certain strategic or operational characteristics also. So, one is synergy and efficiency. Mergers aim to create synergies, that is 2 plus 2 is more than 4. So, benefits will ripen which can lead to cost savings, increased efficiency and economies of scale. Then another strategic characteristic is enhanced market power. The combined company often gains increased market share, pricing power and bargaining power with suppliers and customers. Diversification. Companies may merge to diversify into new products or markets, spreading risk and accessing new opportunities. Then operational integration also takes place. The process involves merging the two companies' operational processes, systems and corporate culture. Access to resources. The new entity benefits from pooling assets, technologies, talent and other resources from both original companies. Process related characteristics are also there. So, we have discussed the core characteristics, then we have discussed the strategic or operational characteristic, and then there are certain process related characteristics of merger. So, first process related characteristic may be legal and regulatory compliance. The process involves legal processes, regulatory approvals and compliance with laws like antitrust regulation. In US they call it antitrust regulation. In India there were restrictions on mergers so that they should not become too big and have a monopolistic power. So, earlier previously it used to come under MRTP, that is Monopolies and Restrictive Trade Practices Act, and now the new act is Competition Act, which is a little more lenient, but nevertheless it is there and it keeps an eye on mergers, and in US there is antitrust regulations are there. Then another process related characteristic is valuation and due diligence. You know that this is a critical part of the process, that is accurately valuing the companies involved and conducting thorough due diligence, deciding about the consideration as well as the ratio in which the shares will be exchanged and with the old company with the new company's share. Now, there are different types of merger. Let us discuss those types of merger. So, the first is congeneric or product extension merger. Now, such mergers happen between companies operating in the same market, as we have discussed in case of horizontal FDI. The new merger results in the addition of a new product to the existing product line of one company. Now, as a result of the union, companies can access a larger customer base and increase their market share. Now, the second one is conglomerate merger. Conglomerate merger is a union of companies operating in unrelated activities, as we have discussed in conglomerate FDI. So, if they are putting FDI in this type of conglomerate, then it is called conglomerate merger. The union will take place only if it increases the wealth of the shareholders. Then there is another type of merger known as market extension merger. So, companies operating in different markets but selling the same products combine in order to access a larger market and larger customer base. Then horizontal merger is obviously there, which we have discussed earlier also in horizontal FDI. Companies operating in markets with fewer such businesses merge to gain a larger market. So, here the purpose of horizontal merger is to gain access to a larger market. A horizontal merger is a type of consolidation of companies selling similar products or services. it results in elimination of competition, hence economies of scale can be achieved. Another is vertical merger. A vertical merger occurs when company operating in the same industry but at different levels in the supply chain merge together. So, this merger happens to increase synergies, supply chain control and efficiency. Now, coming to the next part of the chapter, and that is a lecture, that is acquisition. So, when one company purchases a substantial part of another company's securities and assets or controlling interest, it is known as acquisition. So, this is different from merger. In merger, the two companies voluntarily decide to merge together to form a new entity. But in acquisition, the companies are not aware that one of the company is buying securities and assets or controlling interest totally. They may be aware later on, but lesser negotiations takes place in case of acquisition. But in case of merger, rounds of negotiations takes place. Nowadays in acquisition also they discuss it out, but here the situation is a little more hostile. One company may be strategically buying all the securities or assets of another company and then getting the controlling stake. So, it is a kind of an acquisition. The first company is known as the acquirer and the latter is target company. So, one is acquirer and another is target company. It means one company acquires a controlling interest in the other company. So, in acquisition usually the target company ceases to exist and gets combined into the acquired company. So, there is a difference. In merger, both the companies they decide to merge together and they then cease to exist and a new company, entirely new company comes into picture. But when we talk about acquisition, the acquirer company will remain and the target company will be acquired by the acquirer. So, the target company will lose its existence in most of the cases. Generally, the firms are of different sizes where a large firm acquires a small firm. Now, it means that acquisition is a mode of foreign direct investment where an investor buys a controlling stake in an existing company in a foreign country rather than creating a new one. So, it becomes a kind of a greenfield investment. This is brownfield investment that provides immediate access to target assets such as plants, technology and distribution channels, often leading to faster entry into the market compared to building from scratch. So, if it is acquisition is you are totally taking up existing company, then it is a brownfield kind of investment. Bharti Airtel acquired Zion Africa in 2010. Then you must have heard about a British telecom company, Vodafone acquired the Indian telecom company Hutchison SR in 2007, gaining a significant market share in India. Types of acquisition. Friendly acquisition. Small companies see advantage to be associated with the acquirer, and that is why then there will be no rift. Small company may be willing to be acquired by the acquirer. This is an acquisition where the target company's board of directors approves the deal. Hostile acquisition, as the name suggests, this is an acquisition that is opposed by the target company's management, where the acquiring company gets directly to the shareholders. Hostile acquisitions are also known as takeovers. Leveraged buyout is another type of acquisition. A company uses significant borrowed money to acquire another company with the assets of the acquired company often used as collateral. So, this is known as leveraged buyout. Then there can be reverse acquisition. That means most of the time you must have heard that a bigger company eats up a smaller company, but here the reverse is happening. A smaller company acquires a larger one often to become a public company without going through the traditional method of issuing initial public offer. So, this process, IPO process, you can skip if a small company is acquiring a big company. Then come to the process of mergers and acquisitions. So, these are the steps in the process of mergers and acquisition: review of company, selecting and valuation of target company, negotiation, implementation. First point is, or first step is, review of company. Now, this is the first stage. The company looking for merger or acquisition should review its own organization in terms of assets, structure, vision and future plans. See, merger and acquisition requires huge amount of money, funds, and you may go wrong also, and you may acquire or get merged to a wrong company, which will further eat up your funds. So, it is better to be vigilant from the very beginning. Not only you have to think about the other company, you have to introspect your own company, whether your vision, your mission, your terms of assets, funds, future plans are in for this, or for this type of merger or acquisition, or they are against this type of mergers or acquisition. So, a feasibility study of M&A should be conducted to understand the expectations it will meet. Then the second stage is selecting and valuation of target company. Now, this is a very crucial stage, because payouts are involved or shares will be issued, whatever may be the mode. So, you have to be, and we have to ensure that correct valuation is done. So, a company look for the various companies with which it would like to merge or acquire it. This involves in-depth investigation and choosing the one which best meets its objective, that is the target company. Then comes negotiation. As I said, that in case of mergers, rounds of negotiation takes place. In acquisition, either negotiation do not take place, or they do take place, but not as rigorously as in case of mergers. So, after selecting the target company, rounds of negotiation takes place between the management of the two companies to decide the terms and expectations from the merger or acquisition. A deal takes place between the parties by signing the contract and committing to it. Negotiation does not take place, or very less negotiation take place in case of takeover, negligible, nothing, no communication happens, as the acquirer starts obtaining majority shares of the target company. Then the next stage is implementation. Implementation, after finalizing the deal, the execution of mergers or acquisition starts after formal announcement of the day of the by the companies. So, they will announce in a public release or press release or public gathering that on so and so date this acquisition will start, or merged company will come into existence. This involves corporate restructuring and coordination among the companies. Now, you know that there may be differences in the asset structure of the two companies. So, for that and the structure may be different, and because of that again negotiation takes place between the two companies, or they discuss it out. So, it has to be carried out with due diligence. Now, motives of mergers and acquisitions we are going to discuss one by one. The first is, of course, growth of the company. So, mergers and acquisitions provide a platform for the growth of the company and its operations and size. The external company's resources and capabilities can be acquired and utilized without devoting effort to develop them with its own funds. So, that is the that is the beauty of merger and acquisition, that you don't have to make an effort to create a new organization. You can simply acquire it or get merged with it and get the benefit of whatever benefits are there of that company which is in the foreign land, in terms of resources, knowledge, clientele, anything. Mergers and acquisitions are the best ways to expand in the foreign market. So, by combining with the domestic company, the foreign company gets the access to all the benefits, as I said, local companies, knowledge, and is better able to face the challenges of the foreign market. So, and also you will get the benefit of whatever contracts, whatever contacts that existing company has in that foreign land, the target company has in that foreign land. The company can access resources, knowledge, customer base and market share from the target company. This enhances the competency and builds a competitive advantage for the company. Then operating synergy is another motive of going for M&A. When two entities combine, they are able to operate more efficiently and effectively. It will give more output and profit as compared to when they operate individually. So, that is why we are saying that there is a synergy effect, that means the sum is more than the whole. Then financial synergy will also be there. The value of the combined entity will be more than when they were operating as two individual entities. This has a synergy effect as it will increase the credit worthiness of the entities. The financial synergies will be in the form of improved ability to raise capital from the market, increase in earnings and price to earning or P/E, PE ratio, lowering of the flotation cost because you are not going for IPO or initial public offer. Another motive is power of monopoly. Obviously, when there is a merger or acquisition, now it becomes a big business and they can have monopoly power in the entire market. So, merger of companies dealing in similar businesses increases their market share and bargaining power in the market. The merged entity may enjoy monopoly and will be able to influence the market. Next point is risk diversification. This we have discussed earlier also, that company diversifies the portfolio by merger and acquisition of companies dealing in different businesses. This helps the company to spread the risk and ensure stability. So, this is another motive of risk, merger or acquisition. Tax benefit. The target company may be suffering from losses. The acquirer or the company merging with get tax benefit as the losses of the target company will be allowed to be set off against the profits of the acquirer. So, one can minimize tax burden also. Also, you can better manage your or do the tax planning. Then the last is manager's positive perspective. With mergers and acquisition, the size of the company increases. Now, when the company size increases, its standing in the market increases. So, the income of the employees will also increase. So, it will be a proud moment for the manager to work in a big organization which is the outcome of a merger or acquisition. So, especially of the managerial level, as they will be managing the larger merged operation, which improves their motivation as well. So, although they are in favor, the managers, they show a positive response towards the mergers and acquisition, but they demand a higher returns or higher salary as well. So, let us summarize whatever we have studied in this lecture. So, in this lecture we have discussed a form of or type of foreign direct investment, which is basically mergers and acquisition, and this can be again greenfield or brownfield. So, mergers and acquisition is often seen as the fastest way to achieve growth and expand reach in a new market, as it involves already established companies and operations. A merger refers to the combining of two or more companies into one to take advantage of the combined resources and skills. Now, there are different characteristics of mergers, which include voluntary agreement, new entity, smaller size and scope, synergy, diversification, etc. There are different types of merger, and they can be congeneric or product based merger, conglomerate merger, market extension merger, horizontal merger, and vertical merger. When one company purchases a substantial part of another company, securities and assets or controlling interests, it is known as acquisition. Type of acquisition are friendly acquisition, horse acquisition, leverage buyout, and reverse acquisition. The process of merger and acquisition includes review of company, selecting and valuation of target company, negotiation and implementation. The motives of M&A or merger and acquisition include company growth, expanding foreign markets, competitive advantage, operating and financial synergy, risk diversification and tax benefits. For your reference, international books are there like C.B. Gupta, Sumati Verma, EPG Fatshala, Chaturvedi and others, Hill and Hult. Go through this portion. I hope you have understood the concepts and different types of FDI. Have a nice day. Thank you, students.